We can hear you.
Oh, good. You're
We hear
recording.
you loud and clear.
You're recording, right? Prosper.
Yeah,
You're recording, right?
yeah. I am
Okay.
active. I'm active. I'm active.
Can you see the screen?
Not
Can you
yet,
see
bro.
my?
I'm not seeing your screen.
Okay. Mm.
I'm not seeing. Okay, it's showing now.
Prosper, please let me know when I lose connection. So are we starting now, or are we waiting? Can you guys hear me? It feels like I'm talking to myself. The silence is deafening.
I can hear you. I can hear you.
Okay. So guys, good evening everybody. I'm so sorry for the late. Actually, me and Prosper have been on this thing since like 7 when I dropped that message, because you guys were saying something about wanting to record the call. So I figured that Google Meet, I don't think it was possible for me to record it on Google Meet. So I've been trying to figure out the audio aspect, but I just finally got a hang of it now. So good evening, everybody. Good evening, Prosper, Jasper, Lumine, Soft Joe, Realms. So it's Siska, and I want to. The major person that actually made me consider doing this live class thing was Lumine, because I promised to make a video to explain stacking to him, but I kind of got caught up and forgot about it. So I'm just trying to make up for that and like a little bit of questions or some things I know that could be helpful. So now to do the whole stacking thing, it's actually a bit more about like precision with your entry and confidence, because the truth is sometimes you're very certain, but because of how much positions you're willing to open or you're intending to open, you may just get scared and not, want to take that risk, especially if it's like the entire money you have in your MT5 that you're trying to risk. This is VIX 75, 4-hour time frame. And I'm trying to look for the trade I took last. So I'll just use that to like explain the entry. Okay, I think we're doing this. And then like 1 hour. And since I'm already here, let me just explain. So how I take trades on VIX usually, literally everybody's saying the same thing, Sha, from like all the classes I've taken. But how I take trades majorly is you first find like your current range, because most times I know like everybody says you should look for your where the market is trending to or something like that. We know VIX is selling, but in between your order flow could be like bullish, or there may be temporary buys in between. So what I just do is I come to look for the current trend, like the current range rather. So here, from these points down here, but you see that price did not break structure here. This was a week. So that's really not like the point to start from. So it's going to be like from here to here, and then we broke structure here. So here, and then here, and then we broke structure here. So this is where price is currently trading at, between this high and this low, which was what I marked. Then now I go to 1 hour. So I just use like a general rule of thumb. Your last break of structure is always your inducement. But on this VIX, trading synthetics, sometimes price does not really go to take out the inducement. Price just trades within the inducement, and that's because there's like probably a structural liquidity inside that inducement. So if there is, you just watch out for certain things like how price closes or the behavior of the candle. See, if you don't understand anything I'm saying, you could just always ask me questions to explain further. So mapping this structure here now, and knowing that the last break of structure is always your inducement, we are going like this. All of these are not, I won't particularly call them like actual price movements, right? So I'll just draw them like this. This is how I would draw it if you guys were also not on the call. And like this. This was our inducement here. Price got here and then moved. And then we get back here because this is where price broke this structure. And then this is this low. Price did not break structure here. It just wicked it. So that is now a break of structure to this high, right? Again, knowing that we are trading range within range, from here to here, even though it is inducement technically, temporarily, because price is overall selling, it is still our last range. And then the structure before it, which is this. Do you want to ask a question? Okay, and then the structure before it, which is this, right? This zone is your disruption. So until price takes out this guy, I'm still kind of expecting that price is going to like keep trading within here. So you're just going to be moving with what price is doing. And then we go here, tapped on this guy and moved. So if you go to like maybe your 15 minutes time frame, that's most likely what you see, that was like a buy. Wait, let's go back. Also, another thing is some mitigation. Sometimes you see like a low, right, and another low, and then price will come and take out the low and then continue. But sometimes there are some pairs that the mitigation is not that price comes to take out this guy. The mitigation is that price comes to probably tap on whatever engineered this move. So it depends on what you're trading. If you're trading breaker block, order block, whatever. So sometimes you see something like this. Price does not like go below. It just continues. Sorry, that was a mistake. Price doesn't go below. It just does this. This is supposed to be your inducement, right? But it just does something like this. Taps on this zone and then moves. So if you're waiting for price to come down here, to sweep it, you may be missing out on a lot of trades. So the last trade I took was here. Knowing, regardless of the time frame, remember, on 1 hour, all of this thing is still like inside your inducement too. But you're still just trading these minor structures on your lower time frame. So from here to here, we had a break of structure here. Here, price is selling, right? And then we go here. And then we had this, which in this case became our inducement. So all I just really look for is where you have like some sort of advanced market structure or price exhaustion along this leg, right? So if you do have that, then you consider to take like a sell position before you continue. Now, seeing this move here, as far as it did not break structure, it is still trading within. So as far as this whole movement did not break this low here, it is still within this guy, and you're expecting that price will still come and take out this guy because this is still within our, this is still within our, what's the word? This is still our inducement rather. So this would have been your confirmation to take this trade here. So let me show you what you should look out for. If price gets to your POI, when price gets to your POI, the confirmation is actually 3 candlesticks. You want to see the last candle where, are you guys following? Am I too fast or am I saying something that does not make sense? Do you guys understand up to this point?
Yes, you are good. Yes, you are good.
Okay. I'm looking for the block, the rectangle. So your confirmation entry, when price gets to your POI, the first way to enter a trade, the first candle, that is the last candle that forms there. So in this case, is this guy here. Let me zoom it further. In this case, is this guy here, right? This minor bullish movement, this was the last bullish candle to form here. Then the second one has to sweep liquidity. It has to sweep liquidity of this guy. So you can see this week, it took liquidity of this guy and closed within the body of this last bullish candle. Now the third candle has to close below this third candle, the first candle rather. It has to close below this. This one has to sweep liquidity. So liquidity could be the wick, it could be the body, anyone, but it has to, take liquidity from here. The third candle has to close below this guy. So if you see here, we have this bullish candle, we have this bearish candle that formed but swept liquidity from this guy, and then you have this third one that closed below this guy. So usually this is where you start stacking, right? This is where you start opening your multiple position. Now this may form in multiple ways. It doesn't always form the exact same way all the time, but just regardless of the shape or the color or whatever, like you don't really trade the color of the candles, you're trading the behavior. So the first one, there has to be like this candle that closes this movement upwards. The second one has to sweep liquidity from this candle. Then the third one has to close below here, right? That is how you know. Now another candle formation that you could see is seeing something like this. I think this is called the morning star or so. In case you want to look it up on Google, morning star or evening star, something like that. So you want to see this, and then you want to see like a sharp movement. You want to see a sharp movement like a bullish engulfing, but it still also has to sweep liquidity and then close. So this bullish movement, if you see it around your POI and your POI is correct, price most likely would never get back to the extreme again. It would just start selling from there. Now with VIX, you can also use this with trading. Like this is also what I use in like trading. With VIX, sometimes because of the way volatility moves, like sometimes you see that if you go to your 1 minute, you see like there are lots of gaps. So most times, if price moves like that from that zone, there may be gaps there in your 1 minute, and that gap is what price would most likely go back to fill. So let me show you. This is just if you want that extra precise, where it just feels like you probably called Deriv to show you where to enter kind of stuff. there may be exhaustion or gaps around that zone. And that exhaustion is most likely what price, because price has no intention to go back to that zone anytime soon. So most times when there are gaps, you notice that price would kind of do some sort of, a little bit of retracement back there and then continued. So if you notice, this is a very tiny structure. This is like a very insignificant structure, but it still counts. So let me show you. Where would I get that price? I think it's here. So considering from here now, we broke the structure here. It's very tiny, but it's still significant. And then here, it's very tiny again, but I just really want you to see what I'm trying to say, because it applies whether 1 minute or 4 hours or whatever. And then we broke this whole structure here, right? So if you notice, there was exhaustion. Exhaustion is another thing to that price respect when you're trading VIX. So there was exhaustion, this little candle in between, and then it tapped on it and then synced. So most times, if you want to, you want to be extra precise, you wait for price to come back here. But most times price may leave you, because not all gaps will be filled. So price may leave you. So me, usually, if I just have like a very strong conviction that price would come here, if I'm trying to get like a very extra or precise entry, I enter like 70% of my position when I see the 5 minutes confirmation. Yes, your confirmation must be on 5 minutes. So when I see the 5 minutes confirmation, I enter 70% of the position here. So usually to be here, right? As prices, as this candle closes, this is where you stack. So if price does that little bit of retracement, then I'll open like the remaining 30. So that's how you stack with this one. Now, the second way you could stack, do you understand this first before I move? Or is there something you want me to really explain again? Do you guys get it to this point? Or should I?
You understand? No, I understand. I don't know if another person has a question.
Okay. Is there anybody else on the call that gets it, or I should just continue? Anyways, let me just continue since guys are not talking. Okay, so now the second way you could stack is DCA. So DCA is just like the name implies, dollar cost average, right? Now to use that, you have to use, usually what we trade. I don't know if this is the same thing you trade, but what we trade is, so let's say in a bullish scenario, we trade this advanced market structure, price will sweep liquidity, break structure, drop this, break structure. So usually you're expecting price to come and take this guy, and that will be your entry, right? So usually you do this. So to stack with DCA, what you're doing is you're dividing your entry into 3 points. So you have point A here. Sorry, this is point A. Sorry, let me just type everything. So this is point A. B is the low that sweeps liquidity. C is your inducements. So let's say you have $30 you want to stack, and this is your setup. So what you're simply doing is you're opening $10 here. So let's say for price to take you out from here to here, this is where ideally your stop loss would be, right? At this, your stop loss would, like if you're trading it normal, your stop loss would ideally cover B. But let's say you have $30 and you want to open multiple positions. So what you do is you open $10 here at C. So let's say each if you calculate your stop loss, this one you have to use a little bit of stop loss, but you're not like setting stop loss for all of them. You're just mentally calculating. So let's say it's going to cost you $1 from price to trigger you here, and then get to this point that your stop loss is at. So that means with $10, you can open 10 positions at C. Your second entry point is at A, right? Because sometimes there is usually an order block here or a breaker block at this A. So price may react from here. It may just take C, react from A, and continue without getting to B. So you're going to open $10 worth of positions. So if it costs you $1 from C to B, it may cost you maybe 0.5 cents from A to B with your stop loss, meaning that you can open 10 positions at C and open 20 positions at A because it costs you 0.5 cents from here to here. The reason why you're kind of mentally applying stop loss is because sometimes price, especially if you're not using confirmation entry, so you're not paying attention to where exactly price will turn from. So because you're not doing that, price may get to this point and then like just start selling, and since you're not sitting on your charts and you're not using confirmation entry, so you just open 20 here and then you have extra $10, meaning that if price gets to this zone and triggers you, obviously if it costs you 0.5 from here to here, right? If you open here, maybe it's going to cost you only 1 cent for price to take your stop loss. So 0.5 here, you open 20. If it costs you 1 cent here, maybe you may be able to open up to 50. So that's how you just set it. So if you're using limit entry, you can use this. You can use the DCA method. Like if you don't want to sit on your chart. Now, sometimes price may get to C, trigger C, and just continue. So that is how you see like those extra precise entries that it feels like, oh, how did this person know that price was going to sell here? Price has triggered C but did not trigger A and B, but you will not see that one. Do you get? Because it's just only going to show this. And it's going to be precise because this is the precise place price sold from. Price may get to A, so it will trigger only C and A, but it will not trigger B. So the person may have like this unopened positions at B, and you probably just be wondering how did they know it was going to sell from here, or how did they know it was going to buy from that exact point? And it's because they just divided it between, these are the three. If your trade is going to hold, then your trade has to definitely turn from one of these three areas. If it did not get to C, that means the trade did not trigger. But if it gets to C and it's going to hold, then it has to turn from one of these zones. So sometimes you may be lucky and it to get to B and it will trigger the whole position. So if it triggers 50, let's say you use 50, you open 50 here. If it triggers 50 here, before you get to C, your initial entry, you're already in profits. So sometimes you may even just, depending on how many you open, you may even just want to close the entire position here safe without the trade moving, or you could just leave it. And obviously, because of how many positions you open here, you would have so much more profits than the positions you opened at C, because this would be like times 3. This is like times 5 of what this will be giving you in terms of profits. So that's how you open this one. Now, I think the third one is just sometimes you may not, like I said, the confirmation entry is always like, I don't know, but so far in my experience, and some of my friends have taught it too, it's kind of, it's relatively what's the word now? It's relatively reliable. But sometimes price may just move. You may see like a lot of candle formation around that zone. So something like, where would I call now? So something like, there are some places where you may not see it precisely, like clean, the way I just described it. So if you see that, just go to like your 10 minutes time frame. You see that it is still the same thing that has formed, but maybe it was not clear on your 5. You just go to your 10 minutes. Maybe it was not clear on your 5 minutes, but it will be clear on your 10 minutes or clear on your 15 minutes. So if you're seeing the movement late because it was not properly formed and you were not certain, you could still enter your trade. So let's say you've seen that it has formed in 10 minutes, but it did not really form the way you're expecting it to form on your 5 minutes. So all you're going to do is opening at retracements. That's just what the third method is about. Just waiting for price to retrace. Because this advanced market structure, it still forms on like your 1 minute, 5 minutes, everything. So as price continues to go back to take liquidity, you continue to open more positions and open more positions. But me, I don't buy into that. Why? Is because with this stacking, if you don't open it at that zone that you know that price will not get back to again, except the trade is invalid. If you continue to open as price is moving, any little movement could take you out, even though the initial positions are still in profit. So for instance, let's say you took a trade here now. Let's say you took a trade here. This is just an example. So let's say you use this, but there's no advanced market structure. This forms everywhere, but the place where it holds the most substance is when it forms around your POI, or like you've seen like your setup. So you take a lot of trades here and price moves, you enter again and price moves. This little movement from here to here could take you out, even though the initial one is in profit. And the reason is because all this load you're putting on top of it, anytime price begins to go against you, the ones you open here will be in loss, the one you open here will be in more loss, the one you open here plus the profit from this initial one is already covering these two loss. So before price will even get to your initial entry, everything has closed. Like some of them will even close in profit, but then because of the loss, everything will just like wrap up. So it's just best that you pick a position and then stack everything at that zone, because you know that most likely price will not get there except your trade is invalid or stuff like that. So that's it about stacking. Do you understand?
Yes, I understand. Thank you so much.
Okay.
No, I guess.
Your what? Are you asking a question?
No, I'm not.
Okay.
Well, I just prefer the 5 minutes 3 candlestick formation. The 3 candlestick formation is usually on 5 minutes. You must like do it, like apply it. You can't apply it on a 15 minutes time frame.
Okay, so the thing is, why 5 minutes? You see this 3 candlestick formation, you can see it anywhere, even on your 1 hour, sometimes on your 4 hours. But the thing is, sometimes you see the move after it has gone. Now, the whole idea behind stacking is getting it precise, right? You want to catch it early so that any other retracement that is happening along the way is none of your business. If you enter from 30 minutes, it may be a little bit late. So let me just show you from 30 minutes. Let's look for an example on 30 minutes. 5 minutes is more reliable. 1 minute will show you exact, because anything that has happened, you definitely see it. But okay, now see this 30 minutes now. So let's say you're taking a trade here. This week is small, but if you go to like your lower time frame, this movement, depending on how many you stack, so price closes here with this candle, right? And then you stack immediately. This movement on 30 minutes it has more impact than on 5 minutes. So this movement from here to here could take you out. Like with stacking, you may have like a lot of losses, and it's not even because you're wrong. Because if you are just taking that trade straight out the way normal people would take it, you would still be in the trade. But if price closes here, this is 30 minutes. All these weeks have more impact than the ones on 5 minutes. So this little movement here could take you out because you've stacked, and especially if you don't stack, like if you overload your account. So usually while stacking, you're supposed to use your free margin should be like half of. So let's say you have 30 minutes, $30 you want to stack with. While as you're opening your position, you want to keep an eye on your free margin to ensure that you're opening half. So your free margin should show you $15. And the reason you're doing that is just because if there are sometimes price just does what it wants to do and then continues going. So if this week is on 5 minutes, if you see a candle with a week like this on 5 minutes, it has less impact because that 5 minutes movement may just be like maybe 1/3 or 1/4 of this. But on 30 minutes, it's going to be more significant. So if you open a lot of positions here, you could possibly be taken out. So that's why the whole 5 minutes ideology. If you open it on 1 minute, it's even so much better. But 5 minutes is more reliable because 1 minute price may still dance around a bit before it starts going to where you want it to go to. So that's why the 5 minutes is more reliable. And most times it's like price, you take the trade and price just moves. So for instance, again here, right? This is 5 minutes, but there was like a reaction here. Price moved from here, tapped on these exhaustions. Another thing, like I mentioned earlier, you have to keep an eye on like exhaustion points, and then continued. You can notice that after this candle, there was a gap here. Let me zoom in. There's a gap here, and if you had stuck here, you'll still be safe because even though this week tried to cover this gap, it did not move crazily above it. It just closed the gap and then continued. Now, even though when price came back here, but from here to here, you should have taken profit share. But even when price came back here, you see that the entire, what's the word now, wasn't taken out. Just tapped on here multiple times and then continue. So usually 5 minutes is like the precise, most reliable time frame for the confirmation.
I get it now. Thank you so much. I really appreciate it.
You're welcome. So do you guys have any other question? What else did I wanted to talk about? Oh, I think range. Someone asked, since we're making a recording, let me just touch on that. Someone asked me about range, like a range cycle. So the thing is, I know that the way most of us are from Rondo's group here, and I know that most of the things we understood from the group was that your range, your inducements, like there may be multiple break of structures and your inducements will still be like far away. But the way I trade now, which is actually like a concept I got from Sabigel, your last break of structure is always your inducements. So if price takes it out, the way you have from here to here, let me see. Let me use 1 hour. So the way you have this from here to here, we had a break of structure here.
I don't think your screen is moving anymore. I think it's actually still.
You don't think my screen is moving?
I don't know if it's just me though, and I just came back now, so. But your screen is still. It's not moving.
I'm moving my cursor.
Nothing is
It's
moving.
moving. It's moving.
Is it moving your own?
Yeah, it's moving. Yeah.
Oh shit! I think it's my. Okay, I switched from the data
Please,
to Wi-Fi.
Prosper,
Let me.
bye. Just gonna lie down. So from here to here, right? And then we had another break of structure here. Now, at any point in time, even though you've not seen everything price wants to do, your last break of structure is always going to be your inducement. That's what you're expecting. So even before price forms this leg, let me start again. From here to here, right? We swept liquidity off this low, and then we got to this point. So we took here, and then so even before price formed this low, it's either we continue to break structure upwards, or you expect that price comes back down here to like take this guy off, right? And then here, so the next break of structure, regardless of all of this stuff, it is still trading within this price leg. So this is the next place we broke. this structure. Now, most times I notice that you waste a lot of time waiting for trades because you're waiting for price to you miss a lot of price movements because you're waiting for price to like follow. Okay, you're waiting for price to come and take out one exact point or one particular thing that you set your mind on, that okay, it has to be this, it has to be that. But if you move with this idea that your last break, even though these guys swept liquidity share in this scenario, but sometimes you see that there are two break of structures and there is no sweep of liquidity. So how can you still take a trade even though there's no sweep of liquidity present? So what you want to do, or what you want to look out for, is that I'm trying to look for like a situation where there was no sweep of liquidity so that I can explain that. Yeah, what I said. That's 30 minutes. I can't seem to find like a good example, but pretty much, right? So if you have to break a structure like this, and this is your inducement, this is your liquidity, but at the same time, this guy did not sweep liquidity. There's no sweep of liquidity here. How you could take a trade is waiting to see that if price gets here, if it takes out this guy and closes with the wick, if it takes out this guy and closes with the wick, then you go to your 5 minutes and look for a confirmation. Okay, I remember there's a trade I took on. I don't know if this thing will still show my charts on TradingView. So on 4 hours, I saw a price movement like this. So you have where's my we had this guy got to this point. We had this guy broke structure here and then here, and then like it continued downwards. Now this is 4 hours. Using the system, so the strategy I trade, there's nothing like sweep of liquidity on 4 hours. So if price breaks the structure now, you should expect buy. But you notice that in this particular scenario, even though price broke the structure, that does not automatically mean that we want to start buying, because that is how price moves, right? Like it's not always okay, we've broken structure, then let's just start buying. Price could break the structure, still come down, break this one, and continue selling. But what does that mean? It means that this becomes like, as of this point, this becomes like the most recent high right here. So from here to here. Now, a lot of persons were looking to buy here, but me, I was just looking to see the price reaction. Now, at this stop here, you notice that price came here, closed with the wick. So anywhere there's like price gets to that high or low and closes with the wick, especially on this 4 hour time frame, you just go to your 5 minutes and look for a confirmation to sell. So that was why I got in pretty very close to this movement, whereas people were waiting for price to break the structure before they enter. So when this bullish candle formed, then I saw this doji, right? And I saw this other candle form. It traded above it, but closed again below this doji. That was my indication to look for a confirmation to sell. So if you just go to your 5 minutes, you map out the other block, or I don't know what you trade, whether it's FVG or whatever, you map whatever it is you trade around here, you definitely see a confirmation on 5 minutes. Then you can take the trade from there. That's how I took that. So anytime you have you don't see a sweep of liquidity, right? But price gets to that zone and closes with the wick, you just look to take a confirmation around that movement, that price movement, and you can comfortably write it down. You can try it on any time frame, you can try it on any pair, you can try it on anything you're trading. It's always the same. I think that's the only thing I remember someone asked me. But if you guys have any question, you can ask me. I would be very willing to explain. And if that's all, maybe I should go back to my sleep.
Yeah, hello, Queen. Can you hear me?
Did you say hello, Queen? Okay. Okay, yeah, I can hear you.
I guess now your name is Queen now. Oh,
Yeah,
okay,
I can
Queen.
hear you.
Okay, yeah, please, I'm so sorry I came late. So I can't listen to all what you said earlier, Sha. Maybe if there's a recording for it.
Okay, so is there anything precise? If you have a precise question, do you have a precise question of what you want me to explain, or?
Hello, I can't hear you.
I said, do you have a precise question?
Okay,
So that trade,
it's still under confirmation.
okay, under confirmation entry.
No, just
So,
on that. Yeah.
on what?
I said on that 5 minutes confirmation that you're talking about, because I came late, so I couldn't.
Okay. So that trade I took, I think the $2 to $80 is still the same logic I applied. This is 4-hour time frame. All this price movement have not happened then. When price came back here to this low here, right? This low. You also notice that there was first a low there. Let me draw it. Let me draw it so you see. I'm just explaining so that you're not always waiting for sweep of liquidity. Most times you don't see that. It doesn't even guarantee anything, to be honest. But let me just add that. So you notice that there was this first guy here, right? Moved and then he came down. He did not break the structure. And you had this bullish engulfing candle here that took, I think I would just even say mostly I trade candle movements that covered this middle guy here, right? And then it came down again. Now on this coming down, this last or this third coming down, you notice that price swept liquidity, but it did not close below. So immediately this middle candle, I don't know if you guys can see it, but I'm trying to zoom in as much. With the wick, that was the indication for me to buy. So I even took the buy, immediately this candle closed with the wick, I went to 5 minutes and I got a confirmation. And then I think I traded it to around here before it continued selling. Now, for the confirmation entry you asked me about, I said it's basically just 3 candle formation, or you look for a bullish engulfing candle. When price gets to a zone you're intending to take a trade from, so let's say in this scenario, sell. This is usually what you trade, right? You take this. This is what you take. So when you do it, your POI, I don't know, depending on what you trade, some people their POI is here, some people their POI is here. But me, I'm just saying that sometimes price may not even get to this A and B zone. It would only just get to this C and continue. So what you want to look for is when price gets to your POI, you want to see something like this. You want to see a candle that forms like this. Something that forms like this. So you want to see candle 1, candle 2 sweeps liquidity off candle 1, and then the third candle closes below this. So the same thing too for bullish scenario. You want to see something like this. Do you understand? So if your POI is correct, the idea is that price has no reason to get down here. You stack your position once this third candle closes. You have to wait for it to close. Once it closes, that's where you open your multiple positions. Now ahead, there's another thing I want to even explain. Sometimes, see here, if you even want to trade, if you're trading VIX, I would actually not advise, but I recommend you try this VIX 75. It kind of moves like a robot sometimes. So you see here, and I explained that sometimes price will not exactly form, like I just described, but you want to see something of that nature. So you see this first candle now. This second candle did not close below this last bullish candle here. It did not close below it. It did not close below it, but the wick passed it, right? And if, depending on what your analysis is, if you're certain of your POI, even if the wick, this is 4 hours though, so even if the wick sometimes passes it, as far as it's like price traded past this last candle you have here, whether bullish or bearish in any scenario, you want to start taking, once it closes here, you want to start taking your trade there. If you go to your, because this candle swept liquidity, this one trade below or closed below it or whatever, then you want to start taking your entry here. That's how you stack. So if you're taking, if you take synthetic indices, you should try look into this pair, because it kind of moves. You see, like if it's buying, it's buying. If it's selling, it's selling. It does not do all those back and forth that most of all this one does most times. Like you could kind of pinpoint, if it's going your way, it's going your way. Now the second way I explained that you could stack is using DCA. So DCA is just like using the average price, right? Like last year, February, dollar went to 1.8, and then a lot of people bought dollar, and then it returned back to 1.2. So the whole idea of DCA is that if you bought at 1.8 and you bought at 1.2, when you divide the two together, you no longer bought at 1.8, because 1.8 plus 1.2, your average price per dollar is 1.5. So if you keep buying dollar at 1.2, over time, the rates you bought, that 1.8 is going to, the average is going to be so much more lesser than the 1.8 you bought it initially. So that's the same idea you're using for the entry. If you have these 3 points here as the 3 key points in your strategy or your edge, you want to open, let's say you have $30, you want to open $10 here, you want to open another $10 here, because this guy, even though price swept liquidity off of it, it still has a POI here. I think they call it Quasimodo or something like that. You want to take $10 here. So those times you see people's charts and it's very precise. Sabigal trades this too. The idea is that they've stacked $10 here. So even if price comes here and takes them, these other two will not trigger, but it is precise, right? And then it continues here. So if you with this one too, you also kind of use like a mental stop loss, because you're not using confirmation. You're not waiting on your chart. You're not waiting for it to be precise. So if one trade now from here to here, this is where your stop loss would be originally if this trade is going to hold. So from here to here, if one trade is going to cost you $1 minus $1 in your account, that's going to be like the cost of your stop loss. and you have $10 to stack here, it means you're going to open 10 positions. I don't know if you get it. If you have $10, you have $30 you want to stack. You have 3 positions. You're stacking 10 here, 10 here, 10 here. Now, if trade movement from here to here, where your original stop loss would be, is $1, it means you can open 10 here, right? This second point too, you open 10. So because this one costs you $1 from here to here, this one would cost you maybe 50 cents rather. Okay. So you can open 20 here. Here, maybe it will cost you 1 cent, because if price takes you out here, that means all these things we are doing, we are not seeing right, or we did not get it correctly. So this 1 cent or 10 cents, it means you can open so much more. So if you open 20 here with 10 cents here, maybe you can open like 50 or 60 around the zone. Okay. So at the end of it all, when price starts moving back, you've opened 50 here. So before price even gets to this first entry, you're already in profit. That's the idea. You're already in profit. And it continues to take you downwards. That's how the two works. Do you understand?
Excuse me, I have a question.
Yes, sir?
I have a question.
Okay.
The 3 candle formation pattern, was the third candle close with the full body? Or the third
Your
candle
what?
close to the third candle, was it close with the full body?
The third candle?
Yeah. And the 3 candlestick formation pattern.
Yeah.
Okay.
Like I'm hearing you, but in between your voice just dims. Just
Okay, let me go again. The 3 candle formation pattern.
okay.
Was the third candle close with the full body? The full body, third candle. Was it close with the
No,
full body?
it mustn't close with a full body, actually. It mustn't. It mustn't. But you need to see that price traded below the first candle. You need to see that price traded below the first candle. This is the first candle in our 3 candle formation pattern. You need to see that price traded below it, right? Like there was a potential that it could continue. And then when it closes, that's when you stack. Now, it looks this way here, but sometimes it looks something like this too. See this? That's why I said ignore the way the candle is drawn, but just have the idea, because sometimes I see something like this too. This candle swept liquidity above, it swept liquidity from this one. Sometimes it will sweep liquidity from it and at the same time close below it. So in that case, you can still take your trade even though the third candle has not formed. Let me show you. It's not about the candle, it's about what you want to see. You want to see a sweep of liquidity from this candle, and you want to see that price closes is it below or above it, depending on the situation. So if there's already a sweep and you have like this engulfing candle that closes, sometimes it closes it covers this last candle, then that is still a good indication that there's a strong buying or selling pressure around that zone. So you can still stack at that point, and then like it continues. This for hours. I'm trying to remember something I traded very recently. I have not traded for like 2 days now. But you get it. You want to see a sweep of liquidity, and then once you have that, you want to see the behavior of the candle indicating some sort of buying or selling pressure. I think it was it this guy? I don't know why I always clear my charts. It just gets really uncomfortable having all those plenty drama. Okay, it's that one I was trying to explain to you now. See something like this. This candle is both sweeping liquidity off this one. I don't know if you're saying it. This candle here. This is not an actual trade because I can't see anything at the other side, but I just want to use it as an example. It's sweeping liquidity off this one, and at the same time, it's also closing below this. So you could stack here, right? You just stack as this other candle is forming, you just stack, and then it tanks from there. That's how it works. This guy, you had this guy. Also, know that sometimes some candles are like, I think they call them inside bar. So they form within the movement of other candles. So sometimes just also have that like at the back of your mind. So see something like this too. It swept liquidity off. But I say this guy or this guy. Just swept liquidity. Then you had this strong momentum. These are like areas where you just know that price is going to make some sort of movement, And then if you stacked here, it came back here a bit though before it continued. Here too, it swept liquidity. Again, sometimes you see like you has to be like around your POI because that's the whole idea. If not, all of this stuff is everywhere inside your chart. It's your POI that makes it more, what's the word? It's your POI that makes it substantial. So that's that. Are we done?
Yeah, thank you so much.
You are just changing sticker on this your name. Every day.
Do you mean
So
me?
what? Yes, now. You're always changing
I heard
sticker
it's you.
on your name
Changing sticker.
because yes.
I just changed it today actually. It hasn't been long I joined. I thought it would the session would not even hold today again. So
Sorry, Jai. We're looking for a way to get it to work. So guys, do you have any other question? Or should we call it?
Please, I have something to say.
Okay.
Because sorry, I was not really stable on this stuff, and also my network was a bit shitty because of the movement and all. So, I pray myself that the recording is jiggy because I don't know, the network was shitty. And there's some places where it was freezing. I had to cancel and join back again so I can actually get something, I can hear something. So aside that, I'm hoping on the recording that I will just rewatch everything when I'm more stable. So yeah, so I don't really have. So okay, yeah, there's one question I don't really get. Maybe you explain it, but not really pay attention. But don't get mad anyway. So please, you mentioned something of the 4 hours sweeping and closing with like a inverse hammer or like an exhaustion candle, right? So then after the sweep, you now go down to that's when there's no inducement. Yeah, so you actually sweeps. That's like a transactional liquidity. It just sweeps the point of interest, and then now goes down to then now like close with an exhaustion candle. So then going down to the 5 minutes time frame, is it that after the sweep and that 4 hour candlestick closes when you go down to 4 hours time frame, or that is the part I did not get. My screen froze, and before I couldn't, like it has froze like five
I don't
times for
understand the
you.
question.
Okay, now the question now is there. You said you mentioned something of the 4 hour time frame here when the candle sweeps when there's no structural inducement, right? So it actually sweeps your point of interest. That is maybe a high or a low or something, yeah. And then close with an exhaustion candle. That is with a long, very long wick, right? So now are we going to wait for that wick for that 4 hours candle to close before we go to the 5 minutes time?
I can't hear you again, though.
My network is. This is what I'm trying to explain. My network is shitty, like it's crazy.
Your network is what? Can you just explain your question? Leave the explanation of why you cannot talk. I beg.
I think he's talking about whereby strip liquidity of a
He's
week.
talking about what?
Yeah, I think he's talking about whereby strip liquidity of a week and close below. So is it that he waits for the closure of the count on the 4 hours or equals to the 5 minute ID?
Okay. So the example I gave you about if price closes with the week, right? Even if you're not seeing, this is like on higher time frame. So even if you're not seeing, um, I'm trying to look for an example. I think I should actually start leaving like my stuff on the chat. So even if you're not seeing the sorry, let me get my thoughts together. Okay, yeah. So if price gets to a point, right? So let's say you're expecting price to take out this guy now, and it gets here and closes with the week. Yes, you have to wait for the week to close. That is how you have like the extra confirmation that okay, there may be a little bit, because remember, this whole movement, this is to us, this whole movement, right, is coming from this guy, this, would I call it order block? I don't know, supply, demand, anyone you call them. This whole movement is stemming from this guy. So chances are sometimes price may get to this point, this zone that this guy, because this is like a strong zone for demand, or this supply. He may get here and still sell again. Do you understand? So what you're trading is the behavior of the candle. If price gets here and you see that it closes with a week is a rejection, especially on a 4-hour time frame, right? You can still take a trade here that sells down to the last break of structure, which is going to be your inducement. Let me draw it out, like, so you see what I am saying again and again and again and again and again and again.
Okay, so I think so can I
Yeah, you
something?
can. Yeah.
So I think the closure of candles matters, even though there's a rejection on any POI.
Why I said even though there's a rejection of any POI.
I mean, you mean that the closure of the candle is very, very important, even though there's a rejection
Yes,
in the higher time frame
the
in
behavior,
that POI.
the,
Yeah.
the behavior matters, because that's why we are leaning towards the behavior is because that is what tells you if that zone is still very active or not. Because if you're just following, most times you say trade with the trend or stuff like that, and you're just trading like this, you say, oh, this is a bullish momentum, right? But sometimes price make the reason why this guy propped up, the reason why this candle now, the reason why price was able to get here and sell is because there's active buying movement around this zone. That is what, like, leave the structure is important, but think about it more in terms of like the behavior. There's a strong buying movement, I believe, what strong buying activities around here. That is why we were able to push it up. And if in paraventure, in getting to this zone, right, sellers are here, this is going to fail and there will be a rejection. That rejection is going to be in form of weak. Now, the reason why I kept hammering on higher time frame is because that is so much more reliable than 5 minutes, 15 minutes, 30 minutes. So if you see that on a higher time frame, that is a good indicator that there is a potential for you to sell and get here. If the buying pressure around this zone again is strong, you will push it higher. But if it's weak, it would break below. So think about it in terms of news. The reason why sometimes price may be buying and then there is news and it will clear everything is because the selling pressure from that news is more than all of these things that has formed from, higher highs and higher lows. The selling pressure from this point is more than all of this. So obviously, if the selling pressure is more, it would clear out till it gets to a point where there's significant buying pressure for it to continue to go higher. That is like, well, okay, wait, let me show you that particular one. Why I showed you that is because sometimes you may be here now, for instance, like that trade I showed you, waiting for, maybe you go down and you're looking for sweep of liquidity. There may not be sweep of liquidity, but from these 4 hours, if price closes here, I'm going to take a trade. From this, let me show you my US oil chart. Fuck, my phone is not charging. So we mapped all of this. I think I traded this like last something. Now notice that again, last break of structure is inducement, right? So we had this guy. Let me just draw the structure complete, because this one, it's always moving like busybody and you just think, okay, which one is high? So we had this guy from here, right? This low to this zone, to this zone, to this zone. Regardless of all this drama in between, we are still trading within this range. Overall, oil is selling, but inside this range, we are buying. Inside this range, this is 4 hours. Inside this whole zone, we are buying. Now, notice that I'm just going to show you that thing I said now with a few examples. This is a low, right? It swept liquidity. It swept liquidity. So every time price comes here, it reacts because of this wick that you have here, and it swept liquidity. So it's your advanced market structure. It is a buy advanced market structure inside a sell trend or selling trend. Notice that when price got here, it closed with the wick. This US oil chart is sometimes like inconsistent, but I think the best one to use is it closed with the wick, right? And then continues. Now, when I was trading this, we got to this zone again. We got to this high. Notice that it closed with the wick. I just had to go to 5 minutes and take a sell. That's how that works. I just had to go to 5 minutes and take a sell. Because based on my strategy, there is nothing like inducement on 4 hours, right? So as far as it gets to this point rather and closes with the wick. Also, sometimes too, if you're always missing your trades, if you're someone who
Sister,
always
sorry for interrupting.
Okay.
Are you there?
Don't interrupt here. Don't interrupt her. Let
Hello.
her finish. Let her finish. Let her finish, please.
Okay. So
Hello,
as it
sorry.
closes with
Are you
the
there?
wick, yeah,
Calm down. Let her finish first, please. Let her
I'm
finish.
here.
No
Ask
vex,
your
no vex,
question.
no vex.
Allow him ask before he forgets.
Are you trying to say that you trade based off rejection price? Sorry, rejection candle closing on the higher time frame.
I'm saying that
Is
on
that
the
what you're
higher
trying to explain there? Network is kind of
base.
shitty.
Okay, are you done asking your question?
Yeah,
Are
I'm
you
done.
done? Okay, so what I'm saying is
Yeah, I'm done. I'm done.
on a higher time frame, because my strategy, can you mute yourself? So I'm saying that on a higher time frame, usual my advanced market structure strategy, they tell you that you have inducements, right, on the 4 hours, but there is nothing like that the way I trade. So what I'm saying is when price gets to a significant level and it closes with the wick, let me just say 7 times out of 10, it's going to sell from there. Down to now, where do you put your, because the fact that it closes with the wick does not mean the entire market movement has changed. But how you know that, where would you be putting your TP, or where would you be expecting it to get to? Because you already know that the last break of structure is your inducement, that is going to be your TP. So I'm saying on a higher time frame, if price closes with the wick, then you should be looking to take a trade from that point. Also, on a lower time frame, if you have 2 break of structure, sometimes this guy is your inducement, right? But sometimes this guy also sweeps liquidity and has a break of structure. And maybe he has like a structural liquidity inside. So inside this guy, you may see something like this. You may see something like this. That is why sometimes on the group, somebody will say, oh, you're my inducement, but the trade would hold because there's already structural liquidity, especially if the price action is like jaga, 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 jaga. There's already enough liquidity for price to continue moving. It has no business to get down here. So you may be here waiting, saying this person is your liquidity, but because there's already like an advanced market structure here, it would take this structural liquidity and continue to go higher. So what you want to see if you're looking to take trade inside an inducement, you also want to see that price has taken this guy, right, and has gotten to this zone and possibly or sometimes takes it out and close with the wick. So if there's an advanced market structure inside an inducement, if price takes it out and close with the wick, it's going to hold. You can try it. You can check it on your chart. If this price action now closes with the wick, it's going to hold. It's going to continue from there without having to get to this. Maybe you have another advanced market structure here. This one is
I
going
get
to hold.
that. Yeah. You're really, really correct based on the fact that I trade that too. I trade just rejection.
So especially if you're even trading synthetic indices, because synthetic indices listens more, or would I say leans more towards your structural liquidity than your, those big break of structure. It just moves crazily. So that's what I'm saying.
Liquidity and just move. It doesn't waste time on PI. Correct. Thank you.
So we are done here, right? Or do you understand what I said? Izu Chukwu.
What do you want us?
See, let me show you guys something. Oh, this guy actually stopped liquidity. I was going to show you that sometimes you have like a break of structure. So don't worry. It wasn't an example I thought it was going to be. I wanted to show you guys something. Oh yeah, Izu, are you done? Me, I want to go and sleep. Does anybody else have question? If we're done, and Prosper, are you clear?
Sorry, I think. Should I say something?
Yeah,
Yeah,
sure.
say something.
I think what we should pay attention also is that where price is basically a form of liquidity where price take out the old 4 hours high, the old 1 hour high, then close below. It gave us more significance that price is going to sell a little, even though it's not selling for long. The closure of that candles at that point will give us an idea that we're looking for shorts. So it's just the idea of us having a form of liquidity and the concept of price going to sweep an old high or low. So I think that's what I work with actually though.
So you see that place I marked on the 4 hours, right? So this is 1 hour. This is the first high here. You notice that the first time price got here, it got rejected. It got rejected, right? Here. It got rejected. It closed below it. And then it sold to this zone. It went there again. It got rejected. It closed with the wick. And then it sold a bit. This is 1 hour.
Yeah.
It got there again. It got rejected. And then it sold. So most times you may just be there waiting for advanced market structure, but market is moving. So you have to pay attention to like the behavior and depending on the POI you choose to pay attention to. So you don't, the advanced market structure thing is good, but most times you may just miss out on a lot of trades. So we've gotten here. If you took a trade here, especially with the confirmation, you would have written this down to at least this was the second break of structure here. Let me draw it out to you. So we had this huge gap like this. So from here to here, we broke structure here. We had this. So if you had used confirmation and you took a trade from here, you would have actually written it down to at least this. This should give you 1 to 4 or so. It got here again, and then it sold a bit down. It got here again before it finally tanked. So what you're looking, the way to see it is these things are not rigid. You're just looking at the behavior, and the behavior shows you where selling or buying pressure is. Because if the buying pressure is not strong enough from here, it was strong enough to push it to this zone, but it's not strong enough to take out this old guy, right? It means that we have more sellers here than we have more buyers. So it's going to tank down. It got there again. Obviously, the number of times it is going to a particular zone, the more buyers would begin to get mixed. Okay, I don't want to say a lot of unnecessary things. Now, if it gets here again, right, and then there's like a rejection. That's why, usually they will say the more a support is tested, the more easily to be broken. That is like a textbook explanation, but you need to also understand, like if you understand the why, you'll be able to easily apply it to. So why is it that the more it gets tested? Because the more you're hitting on something, let's say you have a hammer, you're hitting on a particular point on your wall, the more that point begins to get weak, right, the integrity of that structure begins to get weak. So it has started here like 1, 2, 3. Obviously, you now have like this full release that now like tanks downwards. All of this will still play within your strategy, but I'm just saying that sometimes you miss out trades holding on to the fact that it has to be advanced market structure. It doesn't have to be. It doesn't. Most times you don't have to see that sweep of liquidity. The way price reacts around there too will show you what most likely wants to happen. With that, I think we're done. So can we end the call now? Prosper, are you clear?
Yeah, I'm there. God help me.
Where are you exactly? What exactly don't you understand?
No. It's not really the understanding. I get, and of course, I understand. I've not, I'm not stable now. I'm not paying too much attention. So that's the thing. I'm around. I'm everywhere. But no, I think once I come down and rewatch this stuff, I think I'll actually get all you're trying to say.
Okay, another thing too I want to show you guys is this just came to my mind because sometimes I see it like as a mistake. I won't say a mistake, Sha, because nobody has like the answer to the market. But another thing I want to show you guys is sometimes you see something like this, right? You see this first break of structure. Sorry. The fact that this guy, and then you see this guy, right? And then you expect that this guy gets taken out and breaks structure. The fact that this guy sweats liquidity off this guy, and you say, oh, this is your advanced market structure, except price does another break of structure above it. This guy is still your liquidity. It's something else I feel like sometimes people make mistakes with. But I don't like to walk around correcting charts because the truth is nothing is fixed in you. What say by tomorrow morning may not be working again. But just know that if your last break of structure is your liquidity, regardless of if that break of structure, you have this first break, second break, this one comes again, still liquidity, and except you have another break of structure, this guy is still your liquidity. So that is why sometimes you'll be drawing advanced market structure. Price will sweep that because that advanced market structure you're drawing is liquidity. Even though it has taken liquidity, it is still liquidity in itself. So except you have another break, right? That is what will now shift. You talked about the concept of money transfer. That is what shift this guy to be, this person will now be where you're expecting that price will turn from. The money transfer will now be here. If not, it is still here. So even if this person has swept liquidity, the money is still seated here. If we don't break structure, if we don't have momentum enough to break structure from midway, it is going to come back to take this person. So most times where you have sweep of liquidity and it does not hold, check to see if it is still an inducement. That is where you have your active POI, or what would I call it? Just lean more towards the understanding and leave the grammar, because we are all still trading the same thing. It's just different name. Everybody just renames everything. But just know that if we are looking for liquidity, and if we say we need liquidity to move the market, we need money to move the market, and we have this person as our liquidity, we come back again to take this money and we go. Except we create another movement, meaning that this movement was strong enough to create another movement of its own. This person is still your liquidity. So most times, if you find out that your advanced market structure is not holding, then most likely you're trading liquidity. That sweep of liquidity is still liquidity. That's where the money is still seated on your chart. Okay. So yeah, the reason why I saw that and I wanted to point it out is because of
Maybe
this.
if I tell you to actually do it one more time, come again.
So this is what I'm saying. The reason why I remember that was because of this movement. Now, you notice that from here to here, some people will say this is a sweep, it will be a sweep if you're trading from 5 minutes. But let's just say we have this first movement, right? And then we go again, and then we have this guy. So you say, oh, price came to take liquidity, right? And then broke structure, right? Now, except we have a movement from here, let's say from here now to here, and then continues, then this guy will be your liquidity. If not, this guy is still your liquidity, even though you already swept liquidity from this person. This is where your money is still seated. So you notice that when price came, so most people, if they drew their charts, they'll draw it like this. They'll say a sweep of liquidity, and they tell you that you should use the most recent price action. So they'll say, okay, this is sweep of liquidity. Then maybe they'll say, okay, all of this stuff inside, maybe when you go down, it will be like something to trade, maybe structural liquidity or something. But if your last break of structure is liquidity, this guy is still liquidity. It is still an inducement. That is why you have this movement that came to clear it out. Okay, so if you had taken this trade from a much lower time frame, you'll be wondering why it did not hold. It is because it is still your inducement, even though it swept liquidity. So you'll be wondering why this guy did not hold. But price took it, and then you had this full release from here to here. That's what I'm saying. So just have it at the back of your mind, even though that last break of structure swept liquidity, right? If there is nothing else in front of it, that is your liquidity. That sweep of liquidity that you have seen is still your liquidity, because for the money transfer to have shifted, there have to be another structure in front of it. For you to have expected that this guy would hold, you need to have had another break of structure in front of it. So as far as there's no break of structure in front of it from this time frame, then expect it to be taken. Expect it, because it is still the last break of structure you have. Expect it to be taken. So it takes it, and then you have a full release. Do you understand?
Yeah. Understand.
Yeah.
Sharp. Thank you very much. We appreciate.
Okay, guys. So
I appreciate.
nobody else has another question, right?
Thank you so much.
Is there any other question? I think I'm JP.
Okay. And
So,
good night, guys.
and then one last thing. So, do you normally start your own top-down analysis from the daily, then do your main stuff on the 4 hours, then 1 hour, 15 minutes of your entry or stuff? Like aside the because since most of your time frame is on the 4 hour, your structure and stuff is on the 4 hours. So do you even go to the weekly or daily, or you just start?
Usually I just start from 4 hours, right? But this is how I just do top-down analysis. I think someone asked me that before too. Let me just explain since we are here. This call is already getting too long. But this is what I do. Because every time people tell you to follow the trend, right? But the truth is sometimes price moves. This chart is pretty tricky in the sense that you can easily just look at it and say, okay, for the most part we are selling. But this is what I would do if I was going to take a trade now this week. Oh, today is Sunday, I'll be Saturday. So you start from this the high or the low you're seeing, right? And I do this, and then we broke the structure here, so let's continue like this. So now, even though it seems like we are buying on this zone, you need to know if price is still trading within like a particular structure or not. So looking at it from here, let me clear everything. Looking at it from here, this low did not break structure, so it's trading within. So this is our last low, meaning that from here on this sell trade or whatever, this sell trend from here to here is still a range. Now we look at the structures inside the range. So we have this low, we broke this low here, so we had this. Sometimes you may want to consider all this small stuff, but me, I don't like to waste my time there. And then we have now again, this is internal liquidity, this is internal price action, okay? And this is my this is my my inducement, because this is internal. This high and this low is your external, but all of this inside is your internal. Don't mistake them for the other. Don't mistake one for the other one. Now we had this, but let's just try to trace what price has been doing. So because this is your internal, you notice that when price took it out, what did it do? It closed with the wick. That's what I was trying to explain to you guys. It closed with the wick. But did you see advanced market structure here? No. But it closed with the wick. That should be an indication for you to look for a sell. And then it continued tanking downwards. Also, on this
I
are you talking to me, Prosper?
No. I'm sorry. It's a VN.
Oh, okay. So on this part, it closed with the wick, so you take a sell, right? You'll notice that this guy is also our inducement because it's our last break of structure going up, but it swept liquidity. That is why you want to see how price reacts to it. You notice that when price got here, it closed with the wick again here. That would be your indication to take a buy. But in this case, there's a sweep of liquidity, so you may be much more, you may have much more faith towards that. But within this internal range liquidity now, you need to know where we are trading. So our focus has shifted from this external. We are trading within here because this is like the high, and then this low still maintains. Okay. Within this, what would I call it? Price action. You also want to this is the same thing you'll be drawing if you go to a lower time frame, actually. But instead of going to that lower time frame where everything is mixed up, I feel like it's so much more easier for you to draw it from here. So you have this, and then you have this. This is your last movement, price movement, right? When price got here, again, it closed with the wick. You take a sell, right? Did we break this structure? Yes, we did here. Now, because we've taken this guy becomes our liquidity, even though it took liquidity from here and broke structure. This guy becomes our inducement rather. Do you understand? So what you're expecting is that, okay, since it is our inducement, you're expecting that if you're taking a buy, price should at least get to this point to take it out, right? Now this guy under the second, or what would I call it? This guy is your disruption. So a disruption is as you're doing this, a disruption is where you know that price wants to at least temporarily want you should not be expecting a sell, because if price takes it out and close with the body, then the buy is most likely to continue. So sometimes you see something like this. The truth is, you cannot really answer one person's question without really explaining other things. But let me just try to do as much as I can. This is your liquidity. This is your inducement. If price takes this guy without breaking this guy, comes back and takes this guy, then you should start looking for a buy. Once there's two break of structure to this other side, you should start looking for a buy. So in this, even though this is a sell, at what point would I have started looking for a buy? Right? Is when we've taken out this liquidity eventually, but we had like another break of structure like we did here. So you just definitely start looking for a buy, because now you see that price has gotten to this point. Although this chart is not really showing, if you go to the Oanda chart or something like that, there is a place that there is a gap. So I just knew that most likely price will go there to want to close that gap since it has already. But me, I won't take a buy here because we're already very close to the external. So I will just chill and see how we react here. Since we already took out this guy with the body, then I'll just chill to see how we react when we get to this zone, and then know if I want to take a sell or not. But all confirmation will still have to come from your lower time frame. So the fact that I saw that this guy closed with the week does not mean, you don't want to be taking trades here because of your stop loss. So once this happens, you want to just go to like a lower time frame. Like, let's say here, you want to go to, I don't know if they will show, because this is a new year. But you want to get to that. Even if there is no sweep of liquidity and you see a confirmation in that zone, take it. Oh, I can't go that far. Even if there's no sweep of liquidity, you can take it. So that's what I mean by trades from higher time. What?
I think with the 15 minutes, you can go that low. You can go that far back.
Let me see. Okay. So you can. Was it here?
Yeah.
So you can see the. When we go here, what is this in here? But let me just move it. When we go here, right? This low, we had this guy move. Then we came back here, and then he tanked again, and then he came back here. He still closed within. I think he closed within also. Okay. It actually moved out of that zone a bit before, but all of these are like lower time frame. That's why I say you have to wait for 4 hours so that you get like your confirmation. You have to wait from like your higher time frame. So once the week closes on your higher time frame, you can take it. Pretty much.
Once the week closes on the higher time frame.
Yes, it has to close on the higher time frame. You're not trading from lower time frame because you're not certain if it's going to go there or not.
Oh, so the 4-hour candle have to completely close before we scale down to the 5 minutes or so to look for that pattern. To look for the pattern to sharp.
Now, another thing I want to even point out is sometimes you see, like price did this now. Okay, based on that gold explanation I gave you, I think I already explained it. On that gold, you notice that first there was a break of structure. So here, on this gold chart now, right? You see that price closed with the body here and formed a new high. But getting to this new high, it closed with the week. So what I'm just trying to highlight with that is that sometimes you just need to see that when we get to a significant point, whether high or low, do we close with the wick or do we close with the body? Because if we close with the body, that becomes, like this becomes like this will now be this now, like this. You now probably want to draw it like this, right? Because it closed with the body. Now, when price gets to this new high, it closed with the wick. So you tank down. So let me go back. I just wanted to visually show you that from there before I explain what I wanted to explain here. So from here, you notice that we had this high here and we had this small low and then this jump, right? And then it came back here. You notice that this high price closed, traded above it, but ended up closing with the wick. Okay. If you draw it again, it means this will be your new high that you're waiting for price to close with the wick from. This will be your new high. So as far as it closes with the wick from it, then it tanks. You should be able to take a trade from there.
And all this principle works with the same thing with VIX, right? I mean, with
Yes,
synthetic.
it does. But the thing is, VIX is more like, let's say, volatile. If you notice now, this oil trade, you see from here to here, just to get to this point, see how many structures are here. But most times with all the synthetic indices, the truth is, if you just want to trade VIX, right, except you're doing that weak closing rejection strategy, the best, in my own opinion, the best way to trade VIX is to go to your 5 or 15 minutes. In my own
Not
opinion,
the 4 hours.
right? The 4 hours is only if you're already at the external. So if price is already at the external and closes with the wick, then I'll take a trade. But I don't really trade the 4 hours on VIX. On VIX, I only just take trades from like the 5 or 15 minutes. And all you want to see is the last break of structure is your sweep is your inducement rather. So let me show you something. I always say this, that I should always leave my trade. But so now you see here, if I was trading Forex, like I explained to you now, I said the last break of structure is your inducement, right? So what would that mean? That this guy is your inducement, okay? But under these synthetic indices, I just find out that it's so much more, would I say, better to trade what you're directly seeing on your charts. So for instance, now you have this sweep of liquidity. All of this is transactional liquidity, but would I say structural liquidity, but it counts, like it still counts. So you may be here waiting that, okay, price should come and take out this guy, but you notice that he got to this zone. So I think I took this trade from here. Okay, yeah, I first saw this guy and I took this trade till it got to this point, right? And you notice what I said about like your last, what's it called, being inducement, it closed with the wick. That should be your indication to take it buy back because it has not fully done what it wants to do. So this is how price moves here. It does this. It keeps going back until it has completely cleared all this stuff here. That's when it will now go and then now get to, I don't know how to explain it to you guys. Wait, let me breathe first.
You need some chill water.
Like, it's something, once you see it, you cannot unsee it. Do you get? Once you get it once, you cannot stop seeing it again. So now you had this and this. So let's even start. Let's analyze it from 4 hours. So you notice that all of this is jaga jaga. Sorry. What did I do? You notice that all these things here is would you call this an uptrend or downtrend? But it doesn't mean it is not tradable. You just need to know what's inside what range, because overall we are still bearish. Overall, if you bring out the bigger picture, we are still bearish. But from this bigger picture now, if we want to draw our range, notice this guy here broke structure here, this guy here broke structure here, this guy here broke structure here, right? So this is our range from here down to this guy here. Okay, now this our guy here, there's nothing like sweep of liquidity on the higher time frame. If you go to it for hours, this is how this would also still appear. But how you trace all this stuff that does not make sense, you still want to be able to trace out the movement. So you have from here to here, and then where did we break structure? I think it was around here. I don't know. This stuff is just no discovering it. So let's say around here, and then here, and then here. We've not gone above here. We've not came below here. So now here, this will be your new range to trade within, right? And then you cover it up. So what happened when we got there? It didn't even, but it shall close with the week, but it didn't even take it out. So when we got there and price reacted that way, you should start looking for a sell, but you have to go to your 5 minutes to get like your confirmation for entry. Now, inside here again, what are like, you need to know your structure within here. So since we broke structure here, this is it. This is what you're working with. This becomes your inducement, right? So all of this zone is where potentially price should start selling back again from. And then we broke out of this guy here, right? So again, we come back here and then we break out again here. So this becomes our inducement. It is a buy inducement too. Like, don't lose track. It's still a buy inducement because overall we are selling, but just still have your mind so that when price gets here, you want to see how it reacts again for you to now know if you should continue to buy or for you to continue to sell. But overall, it's still your inducement. This guy is an inducement, right? This guy is inducement, and this will be your disruption. What I mean by disruption is if price takes out this guy, then you expect to buy for maybe a while. And if price takes out this guy, you need to see how it takes the behavior. That will determine if it will continue selling as normal or if it will go back again and continue buying. So you see that when we formed this, when price is currently trading around this zone. So let's just map out the structure within here again. So this becomes what? This becomes your liquidity for a buy, but the buy is temporarily because overall we are selling. And then this becomes like a structural liquidity within this guy, this disruption. Notice that when we got to that structural liquidity within the disruption, price did not have to get to this low because he probably still wants to buy. It closed with the week, right? It closed with this week here. So once you see this week form, you now go back to your lower time frame to look for your entry. So let's map this out here. I don't know if it shows from 5 minutes. Okay, since we have this, let's read into this data too. Okay, so once you see that stuff form, right, you now start looking. Obviously, you won't see like the exact points because it's one whole candle. Okay, wait. I need to find it. I want to find the exact point, like the exact candles that made up that particular candle that closed. But literally, like I said, everything is still the same thing. Sweep of liquidity, blah, 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 close. You take a trade, sweep, close. But I want to look for like the exact point that candle closed. Is there a way for me to get it, Pascal, be Prosper? Why am I always calling you Pascal? Is there a way for me to get the exact point, like the exact candle on 5 minutes?
You have to mark it up on your high time frame. You know the candles, the time. Look for the time period.
No, all of
Time of
this traded within the candle now, Abi. All of this traded within the candle. I'm trying to see like the exact one.
wait that you close that. Yeah. So when you mark it, just have the time, know the time, and then when you go down to your lower time frame, then you can actually
Okay,
or use that your circle too. Then you can
10.
actually circle it.
Okay. But I think I've noted the time too, so 10.
Okay.
We closed at 10 on 11th January.
Go to your 5 minutes and look for it.
The story is so fucking big. Let me just use the time then.
Yeah. So look for that time period.
Okay, so this particular candle, this candle here was where it closed, right? But because it has already closed with a wick there, we are just looking. Was it here? Yeah. We are looking to see our advanced market structure around here, around this zone. We've already marked it out. Price has already gotten here and closed with the wick there. You're not going to look at here because all of this makes up the movements that you see there. So all you're looking to see now is that price sweeps liquidity and breaks above. So here, let me zoom it. Like, I know most times we say this lower time frame is noisy, but the truth is everything counts, like even down to your 1 minute. This candle here, there's a little bit of wick below it that swept from this guy. This second guy closed above, right? Closed above this candle. So if you are going to take a trade, if you want to stack, if it's a scenario where you want to stack, you would obviously need to like be cautious of your margin. But if you want like a very clean, like no drawdown kind of vibe, you have to see it form in this kind of it has to give this kind of vibe, because when it does this, but notice that this is still within this is the original movement, but notice that this guy is still like trading within this whole candle, like this whole candle movement. Would I call this is demand, Abi?
Yeah.
This is your demand candle. This is your demand candle, right? So it's still trading. This is where you get that precise confirmation. So if this closes from here, there is zero drawdown, and it just continues going up without having to come down.
Yeah. So I have a question on this. You mentioned something. I don't know if you've mentioned before while I was out, but you said something on margin. I think for me,
Have
this
you stopped
margin
recording? Can you stop recording? Because this is too much to. I'm listening.
Oh, the margin. How do you really? Because for me, I think when I stack, even if it goes my direction, yeah. But sometimes even if like gets a bit of drawdown, it's all gone. I've tried to, except I just put normal risks is when it actually like goes away. But if I try to stack, it's like I don't know how to really quantify the margin stuff is just my own problem. I think so. So this
Okay,
margin still have, because I'm not really
margin.
seeing my margin when I'm stuck. I'm just pressing sells or buys.
When I can't take a screenshot to show you, because the free margin thing only shows when you've opened a position. So when you
Yeah.
open a position, position, right? This let me just show you like the strategy thing. You're not really paying attention to those last break of structure because most times price just reacts if there's significant structural liquidity. So let's say price has gotten here now, right? Price
Yeah.
has gotten here, and you take a trade here. Obviously, price still came back up to none of all this drama. You're just trying to get to be as correct as possible. But the reason why you open a free margin is because you allow a free margin is because if this kind of movements happen, you're still correct. Do you understand? It
Yeah.
has not taken this guy, this originator out. It has not taken it out. So you're still correct. The reason why you open and leave half of your margin is because when you're opening, it will be showing you. If you open one trade and you have $30, it will show you how much you have free. So you can stack, but you still want to leave a little bit of movement because sometimes price may still come back. Do you understand? Like to that zone and then
Yeah.
step up again and then continue. So you don't want to be in a situation where price would come back, tap on that zone, and you're correct, but because you overloaded your account, everything would close. So when you're opening position, just be looking, the free margin stuff would show, it will start showing. So you want to be opening till you have at least half of that amount still open. You don't worry, you still be open, you still be able to open a lot of position. But let's say ordinarily, if you open just one position, maybe to show you that you have $30, to show you that you have maybe 29 something remaining. But the more you open, the more your free margin. So what you need to do is that free margin is just to act as a buffer. Anytime price gives this kind of movement that does not take you out and then continues, you still be able to open more and then open more. So what you will now be doing at that point is you're using your profits to open, because the more profits your trades are in, the more the increments on your free margin. Meaning you can trade with the profits that you have not yet realized from the trades. Do you understand? So as that is increasing, then you can still start taking at strategic points. When you see something that like interests you, you just open more position, like that. So it's just something that when you're opening, you just be keeping an eye on it. If you open 1, 2, 3, 4, 5, 10, you look to see if you've gotten to half of the money in your account or not. Because you can open all the money in your account here. Well, if price does any little bit of retracement, everything will take you out. That's why the free margin is kind of like advised. Are you done?
Yeah. Thank you very much. I appreciate it.
Bye.
I'll put it into test and then see. So yeah, I think we are good, right? I guess everyone is filled up, and even so I think we can
Yeah, thank
call
you
it.
so much.
Yeah, thank you very much, Iska.
Bye. You're
Bye.
welcome.
Bye.